After a string of encouraging data points in recent weeks, GDP numbers released today confirmed that China is rebounding. Headline growth came in at 7.8%, in line with expectations. Joining me now is Liu Li-Gang, Chief China Economist at ANZ. Thanks for joining us.
Thank you.
The headline growth was in line with expectation. Where did the growth come from?
Well, if you look at the sources of economic growth, it's mainly from investment. The contribution of investment is much larger than consumption contribution, and largely because China has engaged the mini fiscal stimulus program in the second half of the year. In addition to that, we tend to see a pattern that China's fiscal spending tend to be down mostly in the second half. For this year, 58% of China's central government fiscal spending will be down in the second half.
I mean, we've seen this pattern before. Growth begins to slow, stimulus comes in, investment lifts headline economic activity. Is there any sign of this rebalancing that we've been hearing about a lot, the shift towards consumption?
Well, so far we have not seen any signs of rebalancing of the economy, and given investment still plays a big role in driving economic growth, that means investment share to GDP ratio will still remain quite large. That's why I think going forward, this is not a sustainable growth. We have downward our forecast on China for 2014 to a growth rate around the 7.2%.
One of the major concerns for investors has been the level of debt, indebtedness among local governments. Have we reached a point yet where that level of indebtedness is now a sort of impediment to growth?
Overall, Chinese local government indebtedness is as much as their overall assets, suggesting that perhaps local government is too much leveraged. We think that at this moment the problem is still manageable as long as the local government can be allowed to engage in privatization. In addition to that policy reform, we think that the central government will have to allow Chinese local government to issue debt directly. This will help reducing local government liquidity risk.
One other area of concern has been the property market, which has bounced back quite strongly. Do you think that the Chinese government will be forced to act to keep prices from rising too fast?
They are thinking about some longer-term mechanisms to contain rapidly rising housing prices. For example, perhaps in the coming years, a property tax will be imposed nationwide. If they can initiate such policies, I think a housing bubble can still be managed.
I mean, a lot of these things will be down to government reform. We've got the big get-together next month. Are you expecting anything significant to come out of that?
I think that there are a lot of low-hanging fruits type of reform China can engage. For example, in terms of population aging problem, China could do away this one-child policy. In addition to that, there are a lot of easy reforms in China's financial system. Interest rate liberalization is one, allowing Chinese large companies and the listed companies to go to the capital market to raise long-term funding, and that will help China to build a large and deep capital market. And with that, China could liberalize capital account more quickly.
Li-Gang, I guess we'll have to wait and see what comes out next month. Thanks for joining us.
Thank you.
And you can read plenty more on this at ft.com/China.